Welcome to Investing Uncensored. I'm your host, Andre Stewart. And you guys know I love bringing someone on that can help us make money. But how often do you get a chance to talk to someone that has 20 years of investment experience? Well, that's what we get to do today, actually. And one thing about Earl that I will point out first, most of the time when you get a financial advisor, it costs a lot of money. But what if you could get an advisor to also invest in the same stuff that he's investing your money in? And that's what Earl does. So I want to let Earl give a little bit of background about why he chose to go the route that he did with being able to give away advice for free and why he chooses to invest in the same things that he puts our money in. So, Earl, how are you doing today, Earl?
I'm doing great, Andre. Thank you so much for having me on your show. And there were a lot of questions there, so we'll take it one by one. So let's start with the background first. So I was born and raised in the Philippines. So ever since I was a young kid, I've always been trying to focus on trying to make more money. And so as a first grader, I would go around my school, I look for soda bottles, and I turn them in for the recycling credit. And with that money, I would use that to buy Filipino barbecue pork skewers. And we were talking about food
Yeah,
earlier.
yeah,
Have you
yeah.
had one of those?
Not yet. Oh, yes, I did. I did have one. Yeah, it's
Yeah,
so
yeah.
good. Yeah.
It's so good. Yeah. And then as I grew older, I sold CDs, snappable bracelets, concert tickets, even went door to door to sell fireworks, uh, cell phones. So you name it, I've pretty much sold it. And one day I turned on the TV and I saw the CNBC channel and I saw stocks moving up and down. And
Mhm.
I've always been great at games. I've always been great at math. I was able to get a silver medal for a math competition in seventh grade. And the when I saw all those stocks moving up and down and said, I think I can do this. I think
Mhm.
I can crack the code and figure things out. And I know you're a big trader, so I've tried technical analysis,
Mhm.
all of these Bollinger Bands, moving day averages, so on and so forth,
Mhm.
etc. Options. I know you do options as well. So I've tried everything that I can think of. And I found out that everyone should have their own philosophy and strategy that's suited to their personality. So you're different from me, I'm different from you. My personality is I'm a bargain hunter. I love discounts.
Mhm.
So I gravitated towards value investing, which is popularized lately by Warren Buffett.
Mhm.
And that's the strategy that I use for my clients. And speaking of my clients, one of your questions was how I invest my own money like my clients. So outside of my emergency and opportunity fund, 100% of my net worth is invested the same way as my clients. So unlike mutual fund managers, there was a study done by Morningstar, only about half of them invest even a single dollar in their own fund. That
Right.
is just
Mind
mind
blowing.
blowing.
For sure.
Yeah.
Yeah.
And I can imagine if we try to just guess, and there's no real statistics for it, how many financial advisors invest the same way as their clients? There's probably not many either if the mutual fund managers are not investing their own money. So, yeah, I have every incentive to make sure that my clients make money because if they make money, I make money. And if they lose money, I lose money. So the priority for my time is spent mostly on investment research while other people are, trying to get more clients.
It's funny you said that about the other type of investors that invest people's money. But we talked earlier, you have one of the highest designations that's out there. So, the expertise that you have, and someone might be thinking, okay, well, they probably charge a certain amount. You have the same designation, if not higher, and you don't even charge a percentage. So, why, with you having the expertise that you do, why don't you do like the other fund managers and charge 2 to 3 or 6% or whatever they normally charge?
Yeah, so let me just make a clarification. I do charge a percentage. I do charge 1% of what I manage, and as the amount I manage grows, it goes down to 0.7, 0.6,
Mhm.
0.5%. So I do charge a percentage. I do a lot of things for free for my clients. So
Mhm.
for example, if one of my clients, he has $10 million of net worth, I manage a portion of that, and I help him with his other stuff at no extra charge.
Got it.
So I don't charge him anything for that. For my clients, if they need retirement planning, I would create sometimes 10 projections, 10 scenarios to give them different projections of what the future could look like. And I don't charge for any of that. For my clients, for example, they're retired and they're trying to figure out for this month, should I take my money from my IRA account? Should I take my money from my brokerage account? Should I take my money from my high yield savings account? Where should I take my money for me to spend and go on vacation to the Philippines, for example? So I do all of these things at no charge. And one of the other things that I do that's extremely unique is that for every single investment that I own, I write a lot of investment updates. So after a company reports earnings, I'm immediately analyzing the financial statements, the quarterly report. I'm on the quarterly call, and then immediately I would type up a report saying, this is what happened, this is what I think, this is my valuation, and this is my rating for the stock, and this is what I plan to do. So nobody else does all of these extra stuff at no charge.
That is 100% true. So I'm happy you clarified that. But he is for sure. I remember when I was in my 20s, I kind of worked at different, firms to try to like do something similar to what you're doing. And it was almost like a fee for everything. So it's great that and I take that same approach when I have my own clients when we're doing like financial transactions like real estate or lines of credit. I go above and beyond. And I think the one thing about that is you get loyal customers and you get referrals. So I'm assuming you did that same thing for that same purpose.
Yes, right? Exactly. I always try to go above beyond. I don't nickel and dime people. So sometimes some people hire me on an hourly basis to do a special project. If it took me 3 hours to do it, I would only charge 2 most of the time. So I really try to give them as much value as possible.
Speaking of value, a lot of times people try to get information, and I heard you say this earlier that you were watching CNBC on learning how to, do what you're doing now. A lot of people watch those type of channels for advice. Me and my cousin were talking maybe 2 or 3 weeks ago about how we used to watch that channel and it made us get emotional about our investing. And then we would sell our stocks, or we would make these, super quick decisions based on emotions. So with your experience, how can someone get out of being an emotional investor just because they heard something on CNBC or they saw something on TikTok? What are some fixes that someone can do to limit that?
Yeah, that's a great question. So first thing is that I don't watch CNBC anymore.
Me either.
and people, aside from CNBC, people have to be careful about magazines too, or articles on the internet. So people have to recognize that the media is there to try to capture eyeballs, and the emotions are how they try to keep you hooked. And when you're making emotional decisions, that's never good for investing. And so your question was, how can people try to not be emotional about their investments? And Warren Buffett's teacher, Benjamin Graham, had this book called The Intelligent Investor. Have you read that?
Yeah, I heard about it. I haven't read it yet.
But... Okay, so fantastic book. And I believe it's chapter 7 of the book where he talks about Mr. Market. So imagine the stock market as an emotional person. So I'm sure everybody listening here today can imagine an emotional person that they know. Yeah. Sometimes they're excited and sometimes they're angry, sometimes they're scared. And so think of the stock market as somebody like that. When everybody's excited about something, that's someone who's just being super excited. And when they're scared, that's someone, again, being just fearful of something. And the way to fix trying to be emotional about something is, if, for example, all of us, most of the time, we buy groceries. I think nobody here cannot survive without buying groceries. In the past, everyone needed gas, but now there's electric charging stations. But let's say you were buying burgers, once a month, or going to the grocery store, once a week. Do you prefer for prices to go up or to go down?
Yeah, they got to go down. That'll be great.
Right? That would be great. So why is it in investing that people get scared when prices go down? When then you get a bargain. It's like going to a shopping store. You go to Macy's, go to Nordstrom, and you see a dress for 50% off. That's a great deal. You should be excited when the market goes down. And I think what people need to do is to make sure that when the market is super excited, they have ammunition to fire, meaning cash ready in their brokerage account or in their bank account, ready to be added to their brokerage account so that they can purchase stocks when everyone else is panicking. So if you have ammunition and you know that the market is just like an emotional person, eventually they're going to switch from being afraid to being super excited. And so you can buy things super cheap and watch it go significantly higher, just like the financial crisis. And I know you worked for Wells Fargo and Wachovia, right?
Correct.
So back then in 2008, late 2008, I put 25% of my money in 3 stocks. So 25% each. And those were Wells Fargo. So thank you. American Express and US Bancorp. And 5 years later, those triple or quadrupled up. And so that's the same thing. I mean, everyone was panicking. Everyone was afraid during 2008. But again, if you have cash on the side and if you understand that this is just temporary and you pounce on the opportunity, then that's where the big money is made. And that's how I think people will, can be less emotional about their money.
That makes sense. And I'm really big on reframes. So I'll talk about that a lot. So you just did a great reframe on how someone can look at investing differently with the price being up and then it, miraculously drops. But I think based on your strategy being a value investor, I think you would more so want to tell someone to do cost averaging, because if the price was $75 and now it's $50, would you say that would make sense based on the type of strategy doing like cost averaging to get the price from what it was at 75 down to, now you're in the middle? Would that make sense?
It would make sense some of the time. And so there are many mental psychological biases, and one of them is called the gambler's fallacy. So the gambler's fallacy is like you go to the slot machine or the roulette table, you've lost 10 in a row. You know what? The next pull, the next bet, you're due to win. Or like you're rolling dice, you haven't rolled a 7 10 times in a row. The next time you go, you think it's due. And so that's kind of the gambler's fallacy. In the markets, for example, there's a famous saying that, a stock that has dropped 90% is really something that dropped 80% and then dropped another 50%. So that's a 90% drop. And so the thing with the stock market is that, or for trying to average down, just because a stock is down a third, like you mentioned, 75 to 50 or even 50%, doesn't necessarily mean it's a good deal. You have to, at least for the way I do things, you have to try to figure out what is this company really worth on a per share basis.
Correct.
And for example, we go back to the $75 stock, for example, if the true value of the company is $30 a share, if the stock drops from 75 to 50, it's still not a good buy. So it all depends on valuation. So going back to your previous a different scenario, if your valuation of the stock is 100 and it drops from 75 to 50, then you need to be pouncing on it. Right. So the answer is it depends.
So then how would someone be able to determine what you just said when they're looking at a stock? Is it price earnings ratio or what are they looking for?
Yeah, that's a great question. And so for the majority of your audience, it would be a little bit too difficult to calculate intrinsic value. So I do have a hack for that. We're going to talk about price earnings ratio as well in a moment. But the main hack for most people who aren't astute, or they don't have the CFA designation like myself and looking at the financial statements cover to cover and trying to come up with a valuation, the easiest hack for that is try to get a feel for how the market is feeling. And so if the market hates a certain industry, like really hates it or is really afraid of it, that is a good time to probably sense that the stock is probably undervalued. So an example would be '08. Everybody thought the financial system was going to collapse. And if there is some kind of thought like that, then that's the time you need to be buying. For example, in 2022, tech stocks were hit really hard as well. Some of them are dropping like 70, 80%. And based on the economy was doing fine in 2022. There was nothing like really scary out there, not like 2008. And so I was buying a lot of stuff. And so you try to sense where the market is fearful, and that's kind of your shortcut for people who can't make a calculation of value. Now, for the price earnings ratio, that's how much a company makes versus its stock price. That's a good shortcut, but it has some drawbacks. And the biggest drawback it has is that it can give you some false precision in trying to figure out if a stock is overvalued or undervalued. So let me give you an example. Normally, people think that if a stock is trading under a 10 multiple in the price earnings ratio and lower is cheaper, that means it's a bargain. But however, if, for example, that company, it has poor prospects going forward. For example, their earnings are going to be declining over the next decade. They're losing customers to a competitor, or they have legal challenges that are significant, then even at a 10 PE, a 9 PE, that stock could be really expensive. Conversely, we have seen a lot of stocks recently, like the Magnificent Seven, right? They have very high price earnings ratios, but their growth rates are extremely high and their businesses are extremely durable. So as an example, for example, and this is not financial advice, and I just have to say that disclaimer there, people should consult with their own advisor, and past performance not indicative of the future. But if you think about Amazon, right? So if you think about Amazon, try to close your eyes 10 years from now. Amazon's still going to be around. And as long as their cloud division, as well as their retail division continues to do well, and they have their toes in AI, things like that, even if the multiple seems high, the stock could be undervalued. I'm not going to make a comment as to its valuation today, but when I purchased it in 2020 and 2022, the stock was extremely undervalued, and despite having a high price earnings ratio. The other thing with Amazon is that they invest so much with the future. And so a lot of their investments are treated as expenses. Yeah. So their net income is depressed on the books, but their true earnings power isn't. So price earnings ratios have a lot of flaws in them. And then I'll just mention one last thing, is that accounting, there's so much hocus pocus in accounting that the managers can come up with numbers if they wanted to, whatever they want to show. And so that's why having a CFA designation helps a lot, because I read the financial statements and I can tell if they're trying to be aggressive on their accounting or not. But if people just rely on a price earnings ratio to determine something's cheap or not, they could be fooled by the accounting principles of specific companies. And tech, for example, they do not. If you, for example, go to Yahoo Finance, the price earnings ratio that's published is actually an adjusted number. That adjusted number excludes stock-based compensation. And stock-based compensation is a real expense. It's not a cash expense, but it's a real expense to the shareholders. So it's like a pie, and you're slicing more of the pie to the employees. So the owner of the stocks, which is me and everybody else, we're getting less. So those are real expenses that are not being reflected if you just take a simple price earnings ratio.
That makes sense too now, based on what you were saying. Also, how a lot of times these companies can get away with not paying taxes, right? Because I think Amazon went for some years without having to pay taxes, and it goes back to what you just said. I mean, was it general accounting principles, the GAAP accounting, right? They do something like that, and they can do whatever they want to do.
Yeah.
But based on what you just said now, what are 5 things that smart investors do that you can give advice for? Like just 5 tips that you would think off the top of your head that you can give.
Yeah, sure. So we talked about one of the things, which is mastering your emotions. So you really need to understand that the market's emotional, and you, generally speaking, want to do the opposite. So the big money is not made when the market's going up. The big money is made when the market just crashed and then you pounce. That's where the real big money is made. So having an understanding of that is number one. Number two, We were talking about vacationing to the Philippines earlier, about places to go. A lot of people do a lot more research on their vacations
They
than
suck.
on their investments. Some people, they just, oh, okay, they heard it from someone, the
Yeah, yeah.
stock tip,
TikTok.
they will
Yeah.
they will enter it on their brokerage, and that's it. And but
Uh-huh.
how much time do they research? What flight am I going to get? Where am I going to stay on my, what hotel am I going to stay, so on and so forth. So really doing a lot more research. The third thing is thinking more long term. And I know there are many ways to make money in the markets. Uh, Traders can make money. You can make money in options, currency, in so many different ways.
Mhm.
But I do think that in order to stack the odds for the average person, to stack the odds in your favor, you want to think longer term. And the reason for that is, let me just give you statistics. So prior to 2008, and I'm quoting this prior to 2008, because 2009 to 2025 today, there's been a lot of stimulus, like unprecedented stimulus.
Yeah, yeah.
So this time period is a bit of an anomaly in the longer term history of the markets. But 2008, for the 100 plus years before that, if you had a 1 year horizon, the odds of you making money are about 56% approximately.
Mm.
If you had a 3 year horizon, the odds of you making money jumps up to 2/3. If you have a 5 year horizon, it jumps up to 75%. If you have a 10 year horizon, it jumps to 90%. And if you have a 20-year horizon, it is 100%. Even if you invested in any peak bubble period, you would have made money as long as you had 20 years. So that's one way for the average person to stack the odds in your favor. And then if you combine that with what I said earlier, where you're trying to put the big money in when everyone's panicking, those odds increase significantly. So that's the third one. The fourth one is being mindful of risks. So most people, the average person, when they invest, they only look, how much can I make off this investment?
True.
But risk is extremely important. So for example, if you purchased the S&P 500 over the last 100 plus years, you would approximately get 10%. But if you took leverage, you borrowed money, made it riskier, bought a 2 times ETF fund, 3 times ETF fund, then you would earn multiples of that. So you can't judge someone's performance just based on how much they made. Because if they had a process that was based on luck, for example, eventually that luck's gonna run out. If you're running leverage 3 times stuff all the time, and the market has a downturn, like just like 2007 to 2009, where it dropped 65%, many people who are borrowing money, they're gonna get wiped out. And so being mindful of risks, not just the rewards, are extremely important. In fact, Warren Buffett has some 2 important rules. Rule number 1 is to not lose money, and rule number 2 is never forget rule number 1. So those are his top 2 rules. So it matters because, for example, let's pretend, right? We have a 5-year horizon from today. Let's pretend. If someone has $100,000 and at the end of 5 years, it grew to $160,000. But they took so much risk off of it. And then the market has that 60% downturn. That 160,000 goes down to 640,000. So they're much worse off eventually if their process was not completely sound. So everyone has to be very mindful of how much risk they take. Then number 5 would be just continuous self-education. So in the past, we were talking about PE ratios earlier. In the past, many people had to get the stock price from a newspaper. And then later on, people had to get annual reports mailed to them by the company. There's no internet to get this stuff. Information was not as abundant as it is today. And so if you, in the past, for example, the 1980s to 2000s, 1970s to 2000, something like that, if you were just investing in low PE stocks, you would have made a lot of money. But the market constantly changes. And as an investor, you need to always evolve and adapt to what's new in today's markets.
one thing you brought up Warren Buffett. I always like to quote is he always says risk comes from not knowing what you're doing.
Yes.
So if you do what you just said right now, and I'm all about education and learning whatever it is, because that's like you pay down your ignorance tax by, either getting a mentor or getting someone like you, but just educate yourself. So what you just said is huge. Is just learn as much as you can if you want to get into the stock market. You don't want to just take advice from someone on TikTok or
Yeah.
Instagram. They can say something and it could just be they might have did, like for instance, everyone during the pandemic made a bunch of money because it dropped in March and then it shot up from March all the way until even right now it's still probably higher than it should be. You know what I mean? So everyone just became a stock guru during that time frame, but try to invest right now or try to invest before that. You'd have to do some serious, knowledge or just learning as much as you could. So I like that you pointed that out. One of the
Yeah.
best tips.
And I agree with you. I get so many YouTube ads, Facebook ads,
Correct.
like advertising. I, subscribe to my trading system. It's absolutely free. Or I made 100% on my money in the last 6 months. You can follow all my trades for free. And that's just absolutely a recipe for people to lose their shirts. If you follow them, those people just got lucky. They don't know what they're doing for the most part. 99 out of 100 of them don't know what they're doing. And they're just trying to fool people and trying to get their money. What I would say is that when you're evaluating to follow someone, try to ask them what they were doing during 2007 to 2009, because that was the only real correction in the last 20 years. So 2020 and COVID, that correction was short-lived and it was brought about by an external factor. Correct. The government stimulated like crazy, so the downturn didn't actually went longer than a month. In 2022, it was just simply a subset of tech stocks that actually were down. So it's not really even close to a correction. So there are three main reasons why we are where we are today. And one is interest rates were so low from 2009 to 2021. Yep. The second reason is we talked about the fiscal stimulus was just gangbusters and the government spending like a drunken sailor. So for example, last year, the government spent more than they make, and as a percentage of GDP, they spent at about a 6.4% deficit of GDP. And if we look at history, the only times we've spent that much were during the great financial crisis and also during 2020 and COVID. So in other words, the government is already spending as if we are in a recession today, and that's kind of holding things up. And then the last thing is when we look at money supply, the money supply is significantly above long-term trend lines. Correct. So the Fed has spent so much money stimulating, printing money, that there's so much money floating around that a lot of speculative investments are doing really well. And that's not sustainable. Just like if you had a patient, right? If you had a patient, the patient's sick, you kept injecting steroids to the patient or antibiotics. If you keep doing that every day for a decade, guess what happens, Andre?
Yeah, you handicap that person basically.
Yeah, right? They're gonna get immune to it, right? At some point. So at some point, all of this stimulus is unsustainable. Just like imagine a household. If they keep borrowing money, at some point, they're going to max out all their credit cards. Correct. So at some point, there's only so much stimulus that the American government can do. Now, I'm not saying we're close to the end here, because I definitely think they're going to do it one more time when the economy falters. But there are consequences to that we haven't seen before for many people's lifetimes. So in 2022, we saw interest rates spike up. Everybody thought inflation was dead. In fact, from 2016 to 2020, a lot of politicians, whether it's Republicans or Democrats, they were saying, oh, it's okay, we can borrow money in our own currency. It's not going to cause inflation. And then we saw that in 2022. But the next time a recession happens, I'm pretty sure the government's going to stimulate again, because that's worked before, and that's what they're going to do. And when they do that, there's going to be even more money in the system. And I think that there is a good probability that we will see interest rates higher than what we've seen in 2022. So if we look at history, longer term history, inflation comes in waves of three, meaning inflation rises here, then it goes down, and then it goes higher, and then goes down and goes higher. That happened in the 70s. That happened as well in the early 1900s. And so that's what I think could be, and I emphasize could. Nobody knows the future exactly, but it could be very well possible that we will see double-digit interest rates maybe 5 to 10 years from now, something like that.
And you hit it on the head. I talk about the same thing you're talking about right now a lot of times when I'm doing my podcast on my own. And I think we are running a $2 trillion deficit, which is unsustainable. But back to what you were saying about the inflation, do you think we could be in a period of stagflation right now?
So right now, and
Because
the
it's been hovering, it's up there. You know what I mean?
yeah, yeah. So right now, inflation has been, if you trust the government, and there are many reasons to not trust the numbers that you see published out there because they revise it all the time, and
Correct.
the revisions don't get published. But if you trust the government, inflation is somewhere between 2 to 3%, and if you don't trust the government, we could argue maybe it's somewhere between 3 to 5%.
Mhm.
And if we look at corporate earnings in general, and that's the difficult part when we say in general, because 7 companies are doing extremely well,
On
and
the
the
market.
other 490 companies in the S&P 500 are just treading water.
Correct.
And so if we take a look at, if we say overall in all companies, growth hasn't been that much for a lot of companies. It's only a few companies that have been really driving the growth.
Mhm.
And so it's hard to say we are in a stagflationary environment, because 3 to 5% inflation versus, let's say, 1 to 2% growth is not that big of a differential. Now, if we were to say that inflation was 7 to 10% and then we were only at 1% growth, then that would be a little bit more cause for concern. So I would say that things are not diabolically stagflationary, but definitely earnings growth for a lot of companies have significantly slowed, while inflation has not slowed. So that's what I would say.
Mm.
Yeah.
Interesting. I know you obviously live in California too, obviously around the corner, and you know the cost of living. You know how
Yeah.
much stuff is here in
Yeah.
comparison to other places. And I'm not seeing, any, and they kept saying that prices were gonna go down, or I haven't seen a drop at all in anything except for gas, which is subject to depending on the month. You know what I
Yeah.
mean?
Yeah.
So that's kind of why I'm just like, I don't know. I don't know if, like I mentioned, stagflation, because it just seems like we're just stuck in this period, at least here, where we haven't seen any kind of change in anything, for the most part.
Yeah, and you're right. You go to the grocery store, egg prices are up, beef prices are
Correct.
up, rents are up, real
Hmm.
estate prices are up, and it's just even uh, school supplies, things like that. Everything has gone up, and even my Amazon subscribe and save card has gone up.
Gone up.
So,
Everything's
so
gone up. Yeah.
yeah, everything has gone up, and it's really hard to see that. It definitely feels like there's stagflation out there. When what I was talking about earlier was more of kind of from a corporate view,
Oh yeah, for
corporations
sure.
versus the
Yeah. Yeah.
overall, but from an individual basis. And the reason why it feels stagflationary is that since 2022, inflation has been running hotter,
Correct.
and the average person's salary is, for the average employed person in a corporation or something like that, it's 1 to 2% increase for those years versus an average of 5%. So every year, the average person's purchasing power has diminished. So it
Diminished.
does,
Yeah.
for the individual, it does feel stagflationary. So I agree with you there.
So then, we're kind of on the same page with what we think as far as what's going to happen in the next 5 to 10 years, because what's happening right now with the amount that we spend, and it's not we're not obviously not making any more money because we're at a $2 trillion deficit. What do you think, just based on your own experience, could turn this around? I think Donald Trump, with what he's trying to do with the tariffs and all the different things, people aren't a fan of it. But I don't know how else we can increase the revenue coming in to support trying to decrease the debt. I think we're at 35 trillion now, and I think before he got in, it's just, I don't want to go off on a tangent, but what do you think? What do you think is, looking at a 5 to 10 year horizon, based on the trend or the trajectory right now? I mean, it doesn't look too good.
It's definitely not looking good. I mean, Social Security and Medicare, they
Bankrupt.
need to be restructured. They need so many funds. And if nothing is done in about 5 to 10 years, people's benefits are going to could potentially get cut. Um, retirement ages could be prolonged.
Mhm.
The amounts that younger people pay into the system will be increased, so on and so forth. So there could be many different consequences if nothing is done. And the solution to this problem, the train wreck, you can see the train wreck coming.
Yeah.
The solution to the problem is for our leaders to stop spending like a drunken sailor, and
Correct.
they need to spend less. That is the most important thing that they can do. But there are consequences to that, and that's what's making it hard for our leaders to do it. If they spend less, that's going to be a dampener on the economy, and the economy could go into a recession. And recessions are actually healthy. They should not be avoided.
Yeah.
That's the misconception of people. They want, ever since 2008, everyone around the world, actually, so this is not just the US, around the world, governments have been stimulating, even if there's just a small blip on the radar. They get panicky and then they stimulate. People, they need to understand that recessions are healthy, because if, imagine a hot air balloon, if it keeps going up, up, and up, and you run out of gas, it's gonna fall. The higher it is, the longer it's gonna fall. So if you, what governments need to do is, capitalism and markets in general, they go up and down. When something goes up, they should not make it go too far high up. Let it go back down so they can refuel the balloon and then go back up. But what's been happening over the last 16 years is that they just kept pushing it upwards, and now we're in this situation. So unfortunately, the government has kind of painted themselves into a corner where now, to fix the situation, they have to tighten their belts, and that's not going to be pretty. Or they have to keep stimulating until the fairy tale is over. So just like the story of Cinderella, eventually the clock strikes midnight and
But
everything turns to mice.
that's gonna, because what you're saying is probably what they're gonna do, and I don't know if people understand. Like a house, just 5 years ago, I was gonna buy a house in Arizona. It was $160,000. A year and a half later, it was $350,000.
Wow.
But this goes back to what you're saying. So I don't know if people can correlate the two. With the more money that they spend, it's not like the assets are getting more expensive. Our purchasing power is diminishing because the money is becoming worth less. So it's just costing more and more dollars to buy the stuff that we've been buying, and the value is not changing. It's just they keep spending more money. But you kind of mentioned you gotta let it break in order to fix it. So with what Trump's doing, I'm not sitting here saying we have to get into like, a whole thing about that, but like, do you think some of the strategies that he's trying to deploy with maybe tariffs, or maybe trying to decrease corporate tax, or all those different incentives? Again, we know that most of the money that comes from the government is come through tax revenue or export, import, things like that. What do you think about the strategy that he's trying to do? Because again, you got to break it before you fix it in
Yeah.
a situation like we have right now.
Yeah.
So what are your thoughts about that?
Yeah. So Trump, specifically in terms of trying to lower the corporate tax rate. So in his first term, he lowered it from 28 to 21, and now he's trying to get it to 15.
Mm-hmm.
And so he hasn't officially done it yet. He did campaign for it. So far, a lot of the things that he campaigned for, he has delivered. And so if he does lower it to 15, that is, stimulative. And I disagree with trying to stimulate the economy even more, because it's like trying to add fuel to the fire.
Correct.
So I definitely do not, from a long-term perspective, I think our country is better off not taxing our corporations 15%. I'd rather leave it at 21% so that the revenues of the government don't decrease from that portion.
Correct.
On the tariff front, so the tariff front, he is generating some revenue from the tariffs. However, the opportunity cost of the tariffs in terms of, okay, they're now, if you talk to a lot of people outside of the US, and I have clients outside of the US, I have family and friends outside the US, if you talk to them, a lot of them do not want to buy American made products, or do not want to visit the US anymore. And so a lot of them are boycotting our products, and the trade and the travel revenue that we are losing from the tariffs is more than the revenues that it generates. So that's one thing. And then the second thing is that there's a push to try to make products be made here in America, but or services done here in America. But a lot of the expertise is actually overseas,
Correct.
and it's not overnight that you can just create that expertise. It took decades of companies and employees manufacturing certain products for them to get it right. For us, it'll take a very long time. Plus, if we pay our
Here.
workers here
Yeah.
more
Yep.
versus
Offshore.
overseas,
Yeah.
then that creates lower profits for our companies as well. And from a competitive advantage, our companies in the US will be at a disadvantage compared to other companies outside the US. So I think that while tariffs have some positives, they have negatives as well. And two people can debate on it for a very long time, but in my opinion, I think it brings more negatives than positives.
Positive. I mean, based on what you just said, it makes sense, right? And a lot of people offshore, a lot of, because I mean, if you're trying to hire, because we have at least 15 or 20 people that are offshore somewhere else because it's just more cost efficient for us to do that. And then, with the cost of living going up and trying to hire someone in California or in the States is going to be way more expensive. And you can get that same level of service or expertise somewhere else for a fraction of the cost. So 100% agree. Because if that's the case, then the labor force is going to decrease if we try to get more people here because we're not going to have the funds to be able to hire 10 people here, right? So then again, there goes the tax revenue. So back to what you said, I don't know how we can fix this scenario. I really don't. And so that's kind of why if people have an idea, they should be looking at trying to look overseas to maybe invest or think about retiring. Because if you stay here at the current rate of the growth or the way cost of living goes, if we're not making, because I think the average raise that a person gets is you can't go more than 8%. You know what I mean?
Yeah.
So I don't
I
know.
mean, if you get 4 to 8%, that's a blessing. I mean,
Correct,
most
correct.
people they're getting 1, 2, 3%. So
So
yeah,
it's just
and
I
yeah,
don't know. I don't know what the advice to give on that. I'm always telling people to diversify yourself, not just with stocks, but
yeah,
in other countries too. You got to
yeah.
kind of do something like that too, because it's still time for people to be able to invest and buy something abroad that maybe you can go live in at some point in time, because it's going to start getting more expensive to live other places too. It's just the effect of, you know, inflation, period. You know what I mean?
Yeah, you're absolutely correct. I agree with you. And in fact, foreign markets outside the US, in terms of their stock markets, they're half as expensive as the US markets. In other words, the US markets are twice as expensive. So,
Mhm.
yeah, definitely investing outside the US is a good hunting ground for investments. The other thing that people can do is to have some ammunition ready
Correct.
so that if eventually the clock strikes midnight and things fall apart, you have some money to buy stuff on the cheap, and that way you're not panicking. You're, in fact, if you have a lot of gunpowder, you are hoping and praying that the stock market goes down as soon as possible so that
Mhm.
you can deploy that cash and buy stuff on the cheap.
So then, with that being said, we obviously can't tell anybody how much money they should have set aside,
Yeah.
but would you tell a person to invest in ETFs, or would you tell them to get individual stocks? Because we all know Warren Buffett's strategy: throw it in S&P and let it go, right? But I always talk to my cousin about this because we talked about doing options and things like that. I feel like sometimes you can get a higher return a lot faster by being able to choose the right companies. Even
Yeah.
though the S&P has a lot of companies, like you said, only 7 are in there really holding it up, I think. So do you have is your advice get an ETF, throw it in there, cost average, or do you really take the time to find really good companies and then do it that route?
Yeah. So the answer to your question is it depends on the type of listener who's listening. So, and just clarification on Warren Buffett's strategy. So Warren Buffett's strategy is investing in individual stocks. His advice to the
Oh, okay,
average
okay.
person is to
Mm,
invest in the S&P. So that's two very different things.
got it.
So Warren and I invest, in a very similar fashion.
Mm,
And my advice to the average person is similar to what Warren's suggesting, that they should invest in the S&P 500. The difference, however, I would say, is that most people, great investors, when they encourage people to invest in the S&P 500, they just say, okay, just keep dollar cost, keep investing no matter what price. And
correct.
my stance is that you should invest, but invest in a way that's below where you're supposed to be. So, for example, most people know the 60-40 rule, meaning 60% in stocks, 40% in safer defensive assets. So, if you're normally 60% in stocks in the S&P 500, I would say maybe dial that back down to 50%, dial that back down to 40%. So every month, instead of putting 100% of your savings into an S&P 500 fund, just put half in and then keep half in case the stock market goes down. So that's kind of my advice for the average person. Now, for your listeners who are more sophisticated, I would say definitely pick individual stocks if you know what you're doing. And that's a big if.
Correct.
Because the S&P 500 has the good, the bad, and the ugly. Why invest in 500 stocks that a lot of them are overvalued and pick the ones that are not? And over time, you're going to get rewarded for that. So definitely different advice for different people.
That makes sense because I think Warren Buffett, you're right, does, I think, take like 6 to 12 companies, right?
Yeah.
That's it. And which a lot of things, I don't think people know that too. A lot of times, most companies or hedge funds or private, they just take 5 to 12 companies max.
Yeah.
They're not out here investing in 25 stocks. They're not doing that.
Yeah.
So you're correct with like choosing. And I'm the same way. Me and my cousin have this debate all the time, and she's always like throwing the S&P, and I'm like, I don't know. I would rather just pick my 5 to 6 or maybe even 10, and then just cost average because you've done enough research on those 5 to 10. So you know everything about them versus trying to do that on 500 or even 15 or 20. It's just hard to keep up with.
Absolutely. And like you said earlier, right? Risk is not knowing what you're doing. And
Correct.
if you have 25 companies, that's a lot. And
Awesome.
I at one point in time, for example, during COVID, when everything was dropping, I had 28 investments. And normally I'm only averaging about 15. Today I have 10. So it was like a lot of work. It's like I was like working nonstop just to keep up with everything. But I was like a kid in the candy store. It's like everything's cheap. I want this, I want that. And it was like buying stuff. And but yes, normally you definitely want to keep 5 to 25. I'd say 25 max. And I normally keep about 15. And most people think that you need 50 stocks or 100 stocks to be diversified. No. When you take a look at the research that the academics have produced, and after the 5th stock, the 6th stock, in terms of risk mitigation, the benefits of it decrease significantly, and the 7th stock decrease even more. So after your 5th stock, it's not, the benefits of diversification isn't a lot anymore. In fact, Warren says that why diversification is only required if you don't know what you're doing. And that's why I say for the average investor who doesn't have the time to calculate intrinsic value or study and research companies more than their vacations, then they should stick being super diversified. But if you have the time, you have the intellect, and you really want to do better, then you should pick about 10 to 15 stocks.
100%. I agree. That's kind of, yeah. That's been my strategy for a long time. And I'm like, you mentioned it earlier, I learned reading the newspaper in like 2005 or something, just the thing that at the bottom, just trying to learn how to do it. And then eventually the DVDs came out and all of that kind of stuff like that. So 100%, I think you should educate yourself. But there's so many platforms out here now. And even if you are going to take the advice of somebody on TikTok, it could be a good stock that they're talking about, but you should still just go further in on what that person is saying and not just say, oh, I'm gonna just do this because that person said so.
Absolutely.
So we're not sitting here knocking that 21-year-old who's running an ad talking about, invest with me. I don't know what kind of experience he has, but who knows, right? But still take what he says or even what I say or what Eric says with a grain of salt, right? And then do what you do.
Yeah.
But then the one thing I will say, or my last question, based on you having the experience that you have, what advice do you have for someone right now in this economy to navigate it and still try to be a value investor at the same time?
Yeah, so you can always be a value investor no matter what time. That's first of all. Whether the market's panicking, whether we're currently where we're at all-time highs, you always want to buy an investment for less than what you think it's worth. So if you think a home is worth $1.2 million, you want to pay less than that. If you think a stock is worth $100, you want to pay less than that. So that is timeless. That
Mhm.
principle should be always, you need to carry that for the decades to come. In terms of currently, because a lot of stock prices and real estate prices are extremely expensive, I think people should be more conservative. And so right now I'm
Yeah.
actually having a hard time finding bargains, and there are a few, but they're very rare. I would say, going back to what I was mentioning earlier, if you are the average investor, invest what you normally would. If you're used to putting half your paycheck in stocks, put put a third of it into stocks instead. Just
Mhm.
build up that gunpowder. If you are an investor who does individual stocks, just keep in mind that the economy at some point could reverse course, and make sure that your valuations um, uh, affect, implement or consider the possibilities that earnings are not growing 10% over the next 5 years. It could grow 10% for the next two and then drop 10% for the next two. Just making sure that people have thought through various scenarios, not just like a hockey stick going up. So that's what I would recommend.
I agree with that. Everyone's looking for their home run,
Yeah.
and I think people always try to like remember something good. Like for instance, if you bought stocks when it happened during the pandemic, everyone's probably just still sitting on that high that you got
Yeah.
from buying that stock when it dropped and it shot up. And that's not really investing. If you
Yeah.
can learn how to do, investing in this market now, because it's really hard to invest right now,
Mhm.
you're going to be able to invest in any kind of market, I think.
Yeah.
So then, Earl, with you giving the expertise, obviously you know what you're talking about from an economic standpoint. You obviously have the designation to prove it, and then you just give a lot of knowledge for people right now. Do you have a place where people can go and follow you and get, like short clips or snippets or even read any kind of articles that you have?
Yes. So first, we have a dedicated web page for your listeners. It's mywealtharch.com/investing. So let me spell that really quick. mywealtharch.com/investing. And our main website is mywealtharch.com. I have written interviews, blog posts, and if people want to have a conversation with me, feel free to contact me via email or give me a phone call. I'd be more than happy to talk. Investing is my passion, just like you and I are talking right now, Andre. I could talk to you for a very long time just talking about investing.
100%. And you know what? We definitely got to bring you back. I want to bring you back. I would say maybe in December, because looking at what's going on with the economy, I'm thinking the Federal Reserve is going to drop rates, which I don't know what that's going to do. Again, they're thinking it's going to be stimulative, but we don't know.
Yeah.
Um, I want to bring you back then. I want to
Yeah,
do like
sounds
a
good.
recap and see what's changed and,
Sure.
what are your opinions on the economy at that point in time and what people can do probably for 2026.
Yeah. Yeah. I'd love that.
So Earl, you say Earl Yakosin,
Yes.
at on Instagram or anything like that?
Yeah, yeah. You can look me up on Facebook, LinkedIn, and I also have a Twitter account. So yeah, I'm on the social media channels, so people can look me up that way as well.
Good for you, because I'm on there, but I'm not active. It's so hard to try to like navigate doing so many different things. But anybody that's looking for more advice, Earl obviously dropped a lot of gems for us. He gave you the information to look him up and be on the lookout for him later in the year so he can give us more advice for how to invest in 2026. So again, Earl, thank you for coming on. Look forward
Thank
to
you,
having you
Andre.
back.
Thank you so much. I look forward to being back.
All right.